deficits for a while, often it will correct against them, usually not pleasantly, but that'll kind of fix that structural imbalance, as well as interest rate differentials. And that's kind of how the majority of currencies function. And what's interesting about the dollar is that because the dollar is held by most countries around the world, often in the form of U.S. treasuries, but also like literally deposits in U.S. banks, deposits with the Fed, as well as U.S. capital markets, it basically means that in addition to those normal things, the dollar also has an extra monetary premium on top of it. And so it kind of makes the dollar overvalued on a trade balance basis. And it also uses the global financing currency. So it'll often be the case that, say, a firm in France helps finance an entity in Brazil. It'll be with dollars instead of either of their currencies, just because it's the leading network effect. It's the ledger that multiple different entities can use. And the offset of that is that basically everybody in the world needs dollars because they have dollar liabilities. They invoice things in dollars. And the way that they get dollars is they basically overvalue the dollar, and therefore...
But we don't want the dollar system to kind of fall apart either. Like, is that, that's kind of ultimately the challenge, right? Like, hey, listen, we are all for the dollar weakening here, but we need the dollar system to keep going. Correct?
Yeah, essentially there's a trade-off by being the global reserve currency issuer is basically you get a huge sanction power, and the government it has much easier time finding itself. So, for example, Brazil has similar deficits on a percentage basis than the U.S., but that gives them a currency problem because there's not this like structural demand for their currency, whereas the U.S. Government can kind of get away with a longer runway there. And then the other side is that industrial base issue. And so, generally speaking, they try to maximize both, but it's often hard to do so. And if you look at parts of the administration, like they propose things like taxes on reinvesting capital in the U.S. So like if a foreign entity wants to hold treasuries, they might actually talk about discouraging that at above a certain scale by basically putting taxes on some of those assets and say, okay, you can hold treasuries, but we're going to take back some of the
But when Trump came out and the U.S. administration came out and said, hey, Canada, let's just merge together, or whatever they're saying, Canada will become the U.S. or whatever it is, the first ask on any sort of negotiation. Sometimes I find myself explaining to some Canadians that the reason Canada is rather interesting right now is that over the last 50 years really has been a financialization of the economy. And to me, it seems like we're moving back to, real factories, real goods, real things having more importance and more value in the economy again. And Canada happens to be a country, as this illustration shows up here, that is just full of real things: fresh water, minerals, tons of energy, the ability to produce a lot of hydroelectric power, like all these things that Canada has. So if I was, looking at it, I could see why Canada would be an interesting ask from the U.S. administration. I'm not condoning it or anything right now, but I'm just saying I can see the logic. Like, I get it. Is that, when you hear that from me, is that how you see this chatter about Canada right now coming from the U.S., or how are you looking at it?
I do. I mean, it's the sex when it's going. And in a recent conversation, the way I described this was in environments where money supply grows faster than resources, then there's an incentive to purposely take out debt and buy resources with it, because you're basically shorting the thing that's increasing in supply, and you're using it to go long things that are increasing in supply less. And that creates a more structurally debt-based system. With an example being, there are companies like Coca-Cola or Procter and Gamble that have been around for, like a century, and they've been profitable like every year in my lifetime. And you look at their balance sheets and they have like $40 billion in debt. And then you say, well, why do those big successful corporations have so much debt? And it's because it's a choice. They can issue, in the past, at least they could issue 2% yielding bonds for 10, 20 years, and then use that to, basically increase their capital efficiency. Now, in an environment where money is more sound, and you have something like, like gold has...
Interesting to me about this is that the productivity seems to be increasing, so that like before, if productivity growth was like a negative 2% on the GDP number, or was kind of deflationary at 2%, I feel like now we're entering a world where maybe it's not going to be 2%, like maybe it's 4, maybe it's 6, maybe it's 8. And to offset that, the amount of debt growth that needs to happen, or new monetary creation, M2 money supply that needs to happen to offset that, we're suddenly entering a world where it's a new ballgame, because the productivity growth is now exponentially increasing, it feels to me. Do you think that's off? Like, am I exaggerating that point a little bit?
I think that's true. And the caveat that I might add is that we could see two different directions of productivity in the same time. And so if the world does become more regionalized, so backing up for a second, interest rates, and therefore the debt financing costs have been relatively contained. Like, for example, if you look at that interest rate chart, interest expense was rising. Yeah, so the other one. So if you look at the 70s and 80s, that was up and to the right very sharply. And if you look at the peak zeitgeist, where people actually cared about the public debt, that was the peak. So in the late 80s, the national debt clock went up, the famous national debt clock in New York. And in the U.S., Ross Perot ran what was basically the most successful independent presidential.
I remember,
campaign.
yeah.
And it was largely built on debt and deficit and stuff. So that was like the peak. That the late 80s, early 90s was kind of the peak zeitgeist. But then, as we just talked about, that's when we really started to get like Soviet Union and China opening up to the rest of the world. So we had this kind of period of unexpected disinflation of physical goods. And then so you actually see the interest expense really slow down for quite a while, because we had rapid declines in interest rates. And so even as debt to GDP rose, you tend to have a pretty front-loaded reinvestment cycle. But yeah, a bunch of banks, a bunch of big funds, a bunch of insurance companies, these big pools of capital that hold this. The gross numbers, the majority of it will just be refinancing that. And then so the remaining question is, well, what happens on the margin? Is the marginal buyer in their favor or not? And so I see that metric, and I think sometimes it's overused because they see the gross number, and that's obviously a pretty horrifying figure. But it's the net number that we probably care about more, which is sub 10% of that figure. So I do think that they're going to have issues there, and I think that's also why when you look at the Fed's plan, they're slowing down quantitative tightening, especially on the Treasury side. So they're continuing to let mortgage-backed securities roll off their balance sheet, but they're gearing up toward basically being a good place. It's always a little concerning when you see something go up like 40% year over year. But I do think that the asset itself, when you look at, say, the 5-year performance, I think it makes a lot of sense.
What do you make of? Sorry, I'm going a little rapid fire now on you. What do you make of the Bitcoin Strategic Reserve announcement? What does that mean to you? Anything? Is it like a sign of something to come? What are you making of that?
So far it's in line with my base case, which was that they probably would ring fence their existing holdings. So they have coins from seizures and forfeitures. And so whatever percentage of those coins that are, say, not returned to rightful owners, or legally rightful owners, that they would ring fence that, and that's what the executive order said to do. Basically, when you look at some
like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support. Enjoy the video.
On-chain characteristics. One of the big ones I look at is market value compared to on-chain average cost basis. Because what I'm trying to do is look for the probability of a multi-year correction. Because that's something that obviously readers would want to know about.
Sure.
Want to assess the probability of. And historically, whenever that metric goes up really fast, so the market value goes up like 5x or 10x, and a fairly small number of coins cause that big move. Like, to put it in real estate terms, if there's, like, say 20 houses on a street, and none of them have sold, bought or sold in years, and one of them finally changes hands, and it's 50% higher than its last price. Generally speaking, the value of the whole street now is higher, even though only 5% of the houses 1 out of 20 have basically now moved the price, disrupting that flywheel, either intentionally or unintentionally. And I think we're basically seeing a combo of both. I think that the move is kind of exhausted, and then we are seeing some policy shifts that add uncertainty and make maybe some of that capital want to repatriate or go home. And I think it's disruptive when it happens, but I think it's healthy ultimately because I think that it's gotten rather imbalanced.
Got it. Okay, I have two more things for you in your book here, which I think we all love, Broken Money. Last time we spoke, we brought up something really quickly. I just wanted to share with you because you had me thinking about credit systems, and kind of like how money has evolved over the years. And in your book, obviously, you do a wonderful job of explaining how it's broken and broken money and where we are today. And it made me realize something. As a kid, I was dropped off in this village over in a small country called Croatia. And it was probably like 15 families, maybe 250 people. And the way it would work throughout the year is that, like, if you help somebody harvest like a potato field,
sometimes they'll do me a favor, and then I want to reciprocate and return that favor. And it's still, even though it's long distance, it's still kind of limited by how it's like the Dunbar number, like that conception of like how many like personal connections can we keep in our head at once without having to like write it down and organize it.
Totally.
And that's kind of the village level or the online sub-community level, for example. And so that's kind of our limit. And once we get beyond that, we get into more dishonest ledger types, like historically. And that kind of gradual debasement, one way of kind of putting it is that the issue of the currency gets to change everyone's contracts all the time. And there's all sorts of contracts. Like two businesses will have contracts with each other. A business will have a contract with a customer. And then also everyone's unturned. Probably not that many. I would, and to your prior point, I would just tie that into an earlier statement that inflation's this weird thing because we think of it as one number, but it's really a bunch of things kind of going in different directions. So the scarcest things, like high valued property, that tends to grow in price at the rate of money supply growth over long enough timeframes. Whereas we get way more productive at making electronics, certain types of agricultural products, and then that's weighing down the CPI calculation. And so then they're giving people this target, which is often misleading, because what people really want is they want to be able to afford scarce assets. They want to be able to afford good property, high quality healthcare, really highly nutritious food, and other kind of scarce things, and monetary goods like gold and Bitcoin. And so